Welcome to FT Markets. Federal Reserve Chair Janet Yellen has stoked intense interest in Friday's monthly US non-farm payrolls data by offering an upbeat assessment of the US economy and describing a December rate hike as a live possibility. A favourable jobs report would surely pave the way to that longed-for rates move. But payrolls data have a nasty habit of promising more than they deliver. Last month's figures for September were a shock downside surprise for both the Fed and the market, and no one can be confident that Friday's data for October won't play the same dastardly trick. Well, with me to discuss all things payroll is my FT Markets colleague, Paul McClean. Paul, you've been looking at the relationship between payrolls data and the market, particularly currency moves. What have you been finding?
The data that I've looked at shows that on the day that non-farm payroll data is released, there is normally a knee-jerk reaction on the dollar. So if, for example, payrolls beat expectations, the dollar rises against the yen, the euro and the Aussie dollar. If, however, they fall below expectation, we see the dollar fall against those same three currencies. And that's a fairly well-established trend over the last 12 months.
And here's our first chart, which absolutely illustrates it. Just walk us through this one, Paul.
Sure. So the bars here are representing the payrolls data and whether or not they beat expectation or fell below it. Above the line represents beating expectation and below represents missing those expectations. And as we can see, there is a fairly strong correlation. If the bars are above the line, the dots tend to be two, the dots here representing the currencies, the dollar against the euro and the yen. So a fairly well-established trend with only one or two minor exceptions.
Just goes to show how much the missing has been taking place. I mean, what are economists saying about the October data? What's their prediction?
So, well, last month's data came in at 142,000. There's a range of estimates ranging from about 130,000 to even 220,000 for tomorrow's data. The average looks to be about 180,000. That's the sort of median estimate of analysts, but it could go either way.
Okay, let's look at our second chart, which illustrates the variability between what economists predict and how the data actually comes out. Paul, what's this saying?
Sure. So this here shows us that predictions here are relatively steady. The predictions there are the red line. They're relatively steady. They're not fluctuating too much compared to those revised figures, which you'll also notice are well above those predicted figures. And part of the reason for that is traditionally revisions tend to be upwards. So the first data that is released is normally an underestimate of what the actual figures are, and they get released in the following month's payrolls.
I mean, one of the reasons for this variability we can see in our third chart, which is the seasonality, which just gives you an idea how complex this area is.
Absolutely. You can see it's really quite erratic. You've got peaks and troughs there. There are kind of general seasons and moving up and down with the seasons, but in other parts it is quite erratic. And you can also look at 2015. You can see a real decline there this year in the data, and most people will be looking for that the next bar to go somewhere around the 200 mark, maybe just shy at 180.
Yes, I mean, one of the issues is interpreting the data, isn't it? And what the Fed has been trying to do is condition the market not to panic about a miss. I mean, what we've seen from the Fed is the language changing over the course of this year. At first, they wanted payrolls data to be better than expected. Then they wanted it to come in at around the same level as expected. And now, do you agree? It feels like they're wanting the market not to get too worried if there's a miss on Friday.
Absolutely. From speaking to analysts, the impression I've got is that even if they miss by, say, 20, 30,000, that won't really affect the possibility of a December rate rise. As you said, they've become increasingly hawkish, and I don't think a miss by a few thousand is going to affect the chances of a rise in December that much.
But you can understand why the Fed would be worried, because our final chart is the extent to which payrolls matters to the market. Paul, what's this one saying?
So this is a study from HSBC, and it shows again quite conclusively that payrolls really are the number one piece of data that the market will be looking for, well out ahead of things like GDP and even retail sales.
This is how the weighted importance of different bits of data to the movement of two-year swap rates.
Indeed it is, yeah. And as you can see, the changes in non-farm payrolls there at the top, way out ahead of anything else. And so that's one of the reasons, really, that all eyes will be on the data coming out tomorrow.
dare we predict what this crucial payrolls number is going to come up with?
We dare not. We would expect it to come in around 180, but because of the revisions that constantly get revised up, even if it is a little bit below that, it's not the end of the world, and many people will be expecting for that number to move up in subsequent months when the data gets revised.
Paul, thanks very much. So there we have it, a absolutely crucial payrolls data coming out tomorrow. But it feels like the market really wants this number to come in favourably because all eyes are on a December rate hike.